Okay, so we're going to look at stock and option spread trading versus directional trades. And when you buy a call option, the underlying stock must increase in price above the strike price of the option at expiration, or you will incur 100% loss of the option premium. So that's what you're facing when you're trading options and you're buying calls or puts. You always run that risk. If the stock doesn't close above that strike price, then you incur a 100% loss. So if you have a string of losing trades like that, those 100% losers during a market correction, then your trading account could be wiped out. So we try to avoid that by trading spreads. And option spreads can profit if the underlying stock increases, decreases, or is flat. So this provides a big advantage over directional trades and increases your odds of being a successful trader. And of course, spread trades can increase the percentage of winning trades, and they can help maintain your positions during market corrections without being stopped out of your trades. Now, during the recent market correction, we exited a few of our trades, but we kept probably 90% of them because we had the short component of the spread, which profited as we went through the market correction and the underlying stocks and ETFs went down in price. We were able to maintain our positions during that correction. And now with the market rebounding, of course, we'll take advantage of that with the spread trades, because the long side of the spread will profit as the market recovers. So we're in good shape after this recent market correction trading spreads. And as we'll see shortly, when you leg into an option spread, that can even guarantee a profit for your trade, regardless of the price movement of the underlying stock. Now, we trade 4 types of spreads. We trade the profit guard option spreads, the profit guard stock spreads, debit spreads, and covered calls. Now, we trade profit guard spreads on stocks and ETFs that have low volatility and low cost option premiums. And a profit guard option spread is initiated by purchasing an in-the-money call option and purchasing an at-the-money put option. And profit guard stock spreads are initiated by buying 100 shares of a stock or an ETF and purchasing an at-the-money put option. And profit guard stock spreads are also known as married puts. Now, when you buy a put for protection on stocks or ETFs with low cost option premiums, that reduces the cost of the put protection. And normally, if we buy a stock and buy the associated put, the put will cost anywhere from 3 to 5% of the stock price. So that's the insurance premium you pay to limit your risk on a stock trade, usually around 3 to 5%. And we usually trade profit guard spreads using options that expire in 1 to 3 months. So we're not short-term traders. We don't watch the market during the day. We normally just look at our positions once a day just to see how we're doing, if there's any potential closeouts of the spread. But we're intermediate term traders. We don't watch the market during the day, and it takes very little time to monitor our positions. We also have option calculators that allow you to calculate the profit potential for profit guard option and married put spread trades before we take the trade. So before we take any option trade, we use our option calculators to calculate the profit potential and risk of the trade before we take the trade. We also trade debit spreads and covered calls on stocks that have rich option premiums. And the short leg of a debit spread or a covered call is initiated by selling to open a call option. And debit spreads are initiated by buying an in-the-money call option and selling to open a call option with a higher strike price. And of course, covered calls are initiated by buying 100 shares of a stock or ETF and selling to open an at-the-money call option. And selling calls on stocks with rich option premiums is more profitable than stocks with low premiums. So we like to focus on the stocks and leveraged ETFs that have high option premiums, because when you sell that premium, the time value portion of that premium goes to zero at option expiration. And of course, that's profit if you're short that call option. And we normally trade debit spreads and covered calls using options with 1 to 3 months until expiration. And for diversification, we also will trade longer term spreads using leaps options. And most debit spreads cost between $600 and $800. And you can trade a portfolio of debit spreads in a $5,000 trading account, and your risk is limited to the cost of the spread. And debit spreads with rich option premiums typically have a 25 to 35% profit potential at option expiration. So we'll look on the option calculator, we'll look to get about a 25 to 35% profit potential when we initiate the spread, and we can usually do that if we focus on stocks and ETFs with rich premiums. And we'll look at our option calculator shortly that allow us to calculate that profit potential for debit spreads before we take the trade. In covered calls, we normally look for a 10 to 15% profit potential at option expiration. And again, that's for options that expire about 1 to 3 months out. And we also have an option calculator that allows us to calculate that profit potential for covered calls before we take the trade. So let's discuss the trade selection process for spread trades. So our spread trades always start out with our trade selection process, and we call it prime trade select. And step one is to determine the price trend of a stock using the 50 and 100-day exponential moving average system. Step two is we select a low risk entry point using the Keltner channel. So we'll look to purchase a stock or ETF option if it's in a buy signal using the 50-day and 100-day EMA system. We wait for a retracement to the middle or lower Keltner channel before we make an entry, and then we use what we call the 1% rule to select the option strike price with a high probability of success. So the EMA trend following system determines the price trend, and the goal is to quantitatively measure the buying and selling pressure of a stock. And a stock is on a buy signal when the 50-day EMA is above the 100-day EMA. And this allows us to follow the trend instead of trying to predict the trend. And it allows us to use a system instead of emotional decision making. We've been using trend following for more than 30 years. And our trend following system, the 50-day, 100-day EMA system, worked well in the 2002 and 2008 bear markets when we were heavily short options during those bear markets. We had both put option purchase trades, we had bearish debit spreads, and we had bearish profit guard trades. So we went through those two severe bear markets, and we were profitable with our short positions. And we used prime trade select to select those short positions. So it works both ways, both in bull and bear markets. And step three of Prime Trade Select is we use the 1% rule to select the option strike price. And when you use that 1% rule, the stock only has to increase 1%, and you're going to break even on that trade and start profiting. So that's an important part of Prime Trade Select, is selecting that stock price, that strike price. And when you use the 1% rule, the option trade will profit $100 for each point the underlying stock increases. So if the stock goes up 1%, we break even, start making money, and every 1 point increase will result in a $100 profit on the option trade. So we try to set up these option trades so we have a high probability of success. Now, there's a Metastock module for Prime Trade Select that will generate a list of stocks and ETFs that are on a Prime Trade Select buy signal. So that's the first step in setting up our spread trades, is we use Prime Trade Select to select the stock that we're going to trade. And we can initiate the spread by entering the long and short position simultaneously, or if we purchase a stock or a call option and we have a profit in the trade, we can leg into a spread at a later date. So we use both methods to enter spreads. We enter both simultaneously, and we also will enter from a directional trade. If we have a 30% profit in an option trade, we always enter a spread trade to protect those profits. So I'm going to show you a snapshot of our brokerage account, and it shows our open trades, and we had, when we took the snapshot, we had $901,000 in open trade profit. So here's a listing of the spread trades that we'll be discussing today. This lists the stock or the option here, our entry price, the current price, and our total gain and percentage gain or loss. So when we took the snapshot, we had a $901,000 profit and a 48% average return. So the strategies are working well.